On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope everyone is well. Let's take a look back at last week, then let's turn our attention to what's coming up in the week ahead. It's been a very busy period and there's plenty more to come, so make sure you settle in. If you're listening to this at home, I'd recommend getting a cup of coffee because it could be a little longer than usual. A bit of housekeeping at the start as well. School holidays begin this week, 2 weeks of school holidays. I'm going to take a bit of time off, so we will take a break from these sessions, from these episodes, and I will return at the back end of July when that is all behind us. Right, global share markets. It was a pretty good week last week for most global share markets. The S&P 500 posted its fourth weekly gain out of the last 5 weeks. It rose another 2%, hit new highs, and that's taken the 2024 gain so far this year to 16.7%, which is a very, very healthy return. UK shares were up 0.5%, Europe was 1% higher, and emerging market shares increased 1.7%. The Australian market, the ASX 200 and the local NZX 50 both added about 0.7% for the week. The Topix index in Japan had another very strong week. It was up 2.7%, so that saw the Topix index. Remember, the Topix is a much broader index than the Nikkei, which also gets talked about a lot in the media. The Topix index actually surpassed its previous record high, which came in 1989, so that was very much a milestone. And the Japanese market, the Topix at least, is up almost 22% this year, so it's even been a stronger performer than the mighty S&P 500. US interest rates slipped during the week. The 2-year Treasury yield finished the week at 4.6. The 10-year yield fell from 4.4 down to 4.3. And here in New Zealand, our 5-year swap rate, which is a wholesale rate, ended the week 9 basis points lower at 4.4%. Looking back at some of the key developments, and there was plenty of them, we'll start overseas and then we'll zone in on what happened here at home. There's been lots going on in the UK. We obviously had the general election on Thursday, so Brits woke up on Friday morning with a Labour majority government for the first time since 2010. So a changing of the guard in the UK. That outcome was expected, but what was a surprise was just how strong that victory was. And there are still a few votes that are being counted, but on current projections, and I look at the BBC website to get these, so they might change a little bit, but at the moment, as of Saturday, when I had a look this morning, the Labour Party had 410 seats, which is the most since Tony Blair's 1997 triumph. So it's been a long time since they've had this much success. That would give them a majority of 175, so a very big majority. Interestingly, when you look at the total share of the vote for all the parties, the Labour Party's total share didn't actually move dramatically compared to 2019. It's sitting at just under 34%, and I think it was around that 32% level back in 2019. So it actually hasn't changed a lot, but what has changed more dramatically is the total Conservative vote, which has collapsed from over 40%, or sort of in the low to mid 40s, to about 20%. And a lot of that seems to have gone to the Reform UK party, led by Nigel Farage, who's now an MP for the first time, and you've seen a real splitting of the vote on the right and amongst a lot of the smaller parties. So the Conservatives are now expected to end up with 121 seats. That's a huge change from where they were. They had 365 before this election, based on the previous vote. and that would be the worst outcome in the party's history. So a lot of change in the UK. Markets fairly relaxed. We didn't see a lot of movement in terms of the currency, in terms of the share market, and I think that is because this outcome, everyone saw it coming, and the new Prime Minister, Sir Keir Starmer, has made a lot of statements about how he will be safe and steady. He will be a moderate leader. So there's nothing in terms of dramatic change that the market has seen to give it any cause for concern, but very much a significant changing of the guard in the UK. In the US, it was a busy week in the US too. We had the jobs report, which is always extremely important, and it was largely in line with expectations. For June, we saw 206,000 new jobs created, close to expectations, not too far off what we saw in May, and those numbers were revised down to 218,000. The unemployment rate in the US increased slightly, went from 4% to 4.1. Expectations were for it to remain steady, so it actually ticked up a little bit. Markets expected it to just go sideways. And at 4.1%, the unemployment rate in the US is the highest since November 2021. Average hourly earnings, so wage growth, it rose in line with expectations. It's up 3.9% on an annual basis. That was as expected. It's the equal lowest since June 2021. Put all that together, markets were fairly heartened by the cooling labour market. It does suggest that the Federal Reserve is on track to ease monetary policy in the months ahead. However, I think we do need to make sure we watch the pace of any slowdown in the labour market quite closely. It is a really important piece of the puzzle. When you take the 3-month average of the unemployment rate, you get 4%. And when you look at the low of the past 12 months of 3-month averages, the low is 3.6%. So it's increased by 0.4%. And that's a measure that we know as the SAM rule. It was named after Claudia Sahm, S-A-H-M. If you want to Google her, she's very, very credible, and she writes a lot of great stuff online. She's an ex-Fed economist, and she came up with this rule not as a way to predict recessions, but she wanted an indicator that would help identify when a recession is taking hold in real time. And they wanted to use that, or she wanted to use that, to help the policymakers ensure that support could be provided where it needed to be in a timely manner. So it's more a real-time indicator, but people think of it as a recessionary indicator or predictor nonetheless, because since 1945, we've never seen that measure reach 0.5%, 0.5, without a recession occurring. So it has proved to be quite reliable, and at the moment it's sitting at 0.4, which isn't too far off 0.5. So it is something we need to keep an eye on. You know, there's still a bit of water to go under the bridge. Each cycle is different. And provided that unemployment rises steadily rather than dramatically, we might not even get to that 0.5%, and we might not even see a recession. But that does just highlight how important the labour market is. If you see unemployment rise too much or too quickly, it almost certainly does risk recession in most occasions. So that is just something that bears watching as well. But anyway, that was the jobs report that came out on Friday. So we saw that data on Saturday, and markets like what they saw because it did confirm that expectation that the labour market is slowing, inflation is slowing, and that the Fed will be able to cut rates in the months ahead. We also saw the ISM indices for June in the United States, the Institute of Supply Management indices. You get a manufacturing one, you get a services one. Both of these were disappointing. Both of these fell more than expected. The manufacturing ISM slipped to a 4-month low, but it was the services ISM that fell much more sharply. It suffered its biggest monthly fall in 18 months, and it's fallen to a level that we haven't seen since the COVID period. But apart from that COVID period, we haven't seen it this week since 2009. So definitely signs of the US economy slowing. Pleasingly, inflation indicators did continue to soften further. The prices paid index for the manufacturing sector also fell more than expected, and that touched a 6-month low of 52.1. So good and bad news there. The bad news is good news in a way, but you've got a slowing economy, you've got falling inflationary pressures. Here in New Zealand, we had the QSBO survey for the June 2024 quarter, the quarterly survey of business opinion, which is released every quarter by the NZIER, the New Zealand Institute of Economic Research. And this survey added to evidence that the economy has taken a sharp turn for the worse in recent months. It painted a very similar picture to the ANZ Business Outlook surveys have over the last few months. Firms' trading activity has weakened, the building sector very downbeat, manufacturing also quite downbeat, but across the board pessimism. A quarter of firms reported that they'd reduced staff numbers during the quarter, and weak demand was seen as the primary constraint on businesses. So that really did continue with that theme of much weaker in economic indicators. Pleasingly, as we've seen in other surveys and in other reports, the inflationary pressures seem to drop as well. Selling prices over the next 3 months dropped sharply. They're actually at the lowest levels in 4 years. So that does point to lower inflation ahead. So some good and some bad in that report, but it did corroborate what we've seen with some of the other releases lately. We also had a very soft global dairy auction. The headline GDT index was down 6.9% at last week's auction. That's the biggest decline since August last year, and prices are at a 4-month low. They're still up about 5% since the beginning of the year, but they've definitely come off the boil. And while markets were expecting a fall, they didn't see one coming that was likely to be as big as that. So whole milk powder was down 4.3%, but milk fat products slumped by more than 10%. So not great news for the agricultural sector. Looking ahead, and we'll start with the rest of the world and then we'll move into what is coming up here in New Zealand. But sticking with politics, France will be in focus early in the week. We've got the second round of voting in the French legislative elections taking place on Sunday. That's the 7th of June. I'm recording this on Saturday the 6th, so it will be Sunday by the time you hear this, and it will be Monday here in New Zealand by the time we see those results come out because of the time differences. But a week ago, we saw Marine Le Pen's National Rally Party come first in that first round, and they're still expected to be the biggest party when all the dust settles. However, we have seen a lot of efforts from some of the other parties to make some moves that could stop them winning a majority or performing as well as they otherwise might have. You've had 200 candidates from the left-wing alliance and from President Macron's centrist group drop out of the second round of runoffs, which means that there'll be more one-on-one races rather than sort of 3 or 4 people in the race. And that means you'll see less splitting of votes, which could make it more difficult for the National Rally to achieve an overall majority. Markets have been reasonably relaxed over the last week, but we will be watching how things develop on Monday and watching what we see from European markets when they reopen on Monday evening. In the US, it's also a busy week. Always is in the US. There's always something going on. And this week, it will be the official inflation figures, consumer price index figures for June are out on Thursday, and then we'll get the producer price index, the PPI, that will follow a day later. And we've had some good readings of late, good in the sense that they've been encouraging. The CPI's come in softer than expected for 2 months now, 2 months in a row. And for June, markets are expecting the headline to increase 0.1%, which would see the annual increase slow to 3.1%. That'd be the weakest since March 2021, so more than 3 years ago. The core CPI, which excludes food and energy, that's forecast to have risen 0.2% for the month, and that would see the annual increase steady, unchanged at 3.4%, which is still the lowest since April 2021. So steady as she goes there. That will be the economic highlight globally, that US inflation report for June, but we'll also have Federal Reserve Chair Jerome Powell testifying to the Senate Banking Committee on Tuesday. and the House Financial Services Committee on Wednesday. Every 6 months, he testifies to Congress, or the Fed chair, whoever it is at the time, has to do that. So you always learn a lot, and some of the quotes there and some of the sound bites and some of the thoughts that Jerome Powell shares will definitely be in focus. At the moment, markets see an almost 80% chance of the Fed cutting rates in September. I think some of those slower economic indicators, the jobs report, the ISM services index, some of those other inflation measures having come down, markets have got more confident that a rate cut in the US will happen sooner rather than later. So 77% chance in September, according to current pricing, and a cut is fully priced by November. So we'll just have to wait and see. Also, globally, politics will be in focus, not just because of what we're likely to see in France that I already mentioned and the aftermath of the UK election, but you've also got the annual NATO summit that takes place from Tuesday to Thursday. That's in Washington. And the Indian Prime Minister Modi is visiting Russia this week as well. So lots to keep an eye on. Last but not least, before we move on to New Zealand, it is the beginning of the US reporting season, the international reporting season, I should say, this week, the quarterly reporting season. This will cover the June quarter. And as always, some of the financial heavyweights are set to be some of the first to announce their earnings releases. So on Friday, we will hear from BlackRock, Citigroup, JP Morgan, Wells Fargo. Big day on Friday. We'll get most of those on Saturday, or at least in the early hours of Saturday New Zealand time, but that will be something markets are watching very closely. Not just the financials, you've got a couple of other companies, PepsiCo, Delta Airlines, also scheduled for this week. And as always, the pace of earnings growth will be in focus. For the June quarter, in aggregate, markets are expecting an earnings growth rate of 8.8% for the S&P 500, which would be the highest we've seen in more than 2 years, actually. The financial sector, which will be in the spotlight this week, is expected to not be quite there. It's expected to see earnings growth of 4.3% year on year. So that's where things are sitting. But I think it really is quite important, because for the 2024 calendar year on the whole, markets are expecting earnings growth in the US of about 11%, and that's expected to accelerate into 2025. And the 2025 calendar year, we're expecting to see 14%, 15% based on what analysts are predicting. So that's pretty good, 11 and 14, 15. You look at the average over the past decade, and it's been about 7% per annum. So markets are quite optimistic about what they'll see over the next 2 years, and in no small part that is due to technological developments, artificial intelligence and AI. Those things are expected to be a really important driver of growth, but it will be something that people watch very closely, because the US market is now looking not super expensive, but definitely more expensive than average. And there is some wide differences between sectors. There are some sectors that are trading at very high levels compared to history, and others that aren't. But when you put them all together, the US market overall is trading on a PE ratio, a price earnings ratio of almost 21 times. And that's about 13% above the 10-year average. The 10-year average is about 18 times, and it's about 20% above the 25-year average, which is about 17 times. So in some ways, you could say things have changed because of what we're seeing in AI, and that will be a genuine driver of more growth and better growth and stronger growth than we might have seen at other times over the past 10 years or 20 years. But it also means that the bar is set quite high. So investors will want to see companies meeting those earnings estimates, and they will want to see further evidence that corporate management teams are confident that future earnings growth will be as strong as analysts are projecting. So I think earnings will be increasingly in focus from here on, especially with financial markets having high expectations and indices like the S&P 500 trading at very high levels relative to where they have been in recent history. It's been a strong run. I don't think anyone can deny that. So that is how things are shaping up offshore. Locally, it's also a very big week, and the highlight will be the Reserve Bank decision, which will be on Wednesday afternoon, 2 p.m. That's when you get the release. There won't be a monetary policy statement to go with it, and there won't be a media conference either, so all you'll get is the written statement. There's almost no chance of a change in policy settings, so the OCR will remain unchanged at 5.5%. I think we're all very confident of that. However, markets have become much more encouraged by what they've seen in terms of economic indicators and inflation indicators, and they now see an almost 60% chance of an OCR cut in October, and one is fully priced by November. So in the eyes of financial markets, it's an October-November story, not a 2025 story like the Reserve Bank has been suggesting, and like most of the major banks are still predicting. I know Kiwi Bank is expecting the first OCR cut to come before the end of this year, and ASB has moved its forecast to the same. It sees November as the first cut, but Westpac, BNZ, ANZ still 2025. So there is still a bit of a difference between what we've heard from the Reserve Bank and some of the economics teams at the major banks and what financial markets think. So we'll be watching for any change in tone and any indication that the Reserve Bank might be inclined to move a little bit earlier. I suspect they won't say much at all. So I'm very confident they will play their cards very close to their chest for a few reasons. One being that the June quarter consumer price index report, the CPI report, the inflation report here in New Zealand, is due next week, Wednesday the 17th. I'll be on an island, on a beach somewhere, but I'll still find the time to monitor that. So keep an eye on that. It'll be 10:45 a.m. on Wednesday the 17th of July. And Reserve Bank projections see the annual headline inflation rate at that time falling to 3.6%, down from 4%. So we'll be in the threes now, which will be good. That'll be the lowest in 3 years. Still outside that band, though, that 1 to 3% band. So, and they'll be watching that all important non-tradables component, that domestic inflation that has been really troublesome, really sticky, and it has worried them a lot. But I think beyond that, it's also important to understand that will cover the June quarter, so April, May, June. And the indicators that we've seen lately, like the ANZ Business Outlook, like the QSBO, when they're suggesting that inflation pressures have fallen, they really are looking a little bit further out than that. That's pricing intentions. So it's what firms intend to do with their prices over the next few months. So the impacts of that change that we've seen in terms of the economy, the labour market, demand falling off a cliff, wage growth softening, you might not see all of that in the June quarter. It might be in the September 2024 quarter figures, and they're not out until mid-October. So I think all the signs are good, but it's probably too early for us to see any hard evidence of that, which is why I think the Reserve Bank will still be very coy. They might still talk quite tough. But anyway, that'll be very interesting to watch on Wednesday, and then keep an eye on that next CPI report the following Wednesday. And then the really interesting one for me is the one that comes 3 months after that. Also this week, we will get a fresh housing market report, or we should do. I think that's expected on Thursday or Friday. If it's released on the usual schedule, sort of 9th or 10th business day. This will be from the Real Estate Institute. Everything we've heard everywhere else, and from CoreLogic, QV, whoever, it's all been pretty subdued in terms of where the housing market's at, and that's what I'm expecting from this report as well. You would think the market will be quite sluggish. There's just so many challenges out there with high mortgage rates, with a slowing economy, with unemployment rising, with people not having that confidence around their job security. All of that points to a fairly subdued housing market, so not expecting that to be fantastic. That's probably most of what we've got. Just looking quickly at my calendar. Have I forgotten anything? No, that's it. It's another busy one. Lots to keep an eye on. The outcome of the French election, that will be important. The US CPI report, that will be important. We'll hear from Jerome Powell twice. That will be important. The Reserve Bank, I don't think they'll give much away, but it will get a lot of attention. And some of those corporates in the US and elsewhere that are set to announce results, that will be really crucial as well, given that markets have just had a really good run and that people will be wondering if that will continue without any speed bumps. It's been a while since we saw a sell-off. So many would argue that we are due for a little bit more volatility, and we'll keep monitoring the US political situation. Joe Biden seems to be digging his heels in and saying, I will stay put and I will run, which is an interesting move. I think that story probably has a little bit more to offer us in the months ahead, because the gaffes keep coming thick and fast, and there will still be a lot of pressure on him to rethink that approach. And if he doesn't, some would suggest that he's handing it to Trump on a platter. So we'll keep an eye on that situation too. All right, enjoy the next couple of weeks, and thanks for listening, and take care all. Hope you have a great week, great couple of weeks, and we'll talk again soon.
For more insights, visit craigsip.com.